Piers Bolger, the Chief Investment Officer here at Infinity Asset Management, and welcome to this quarterly update as it relates to the Infinity portfolios. Well, certainly if we looked at the March quarter, it was actually a really strong period for financial markets, and really thinking about the performance that we've seen calendar year to date, it really did start way back in the second half of 2020. And as you're probably aware from the team over at Carringtons, we've made a number of changes to the portfolios over the last 6 to 9 months in terms of being able to capture that growth aspect associated with the changing market dynamics, particularly as we started to see greater level of support come from governments as well as central banks. And just the rollout of the vaccination program through the back end of last year has really provided a big fillip to financial markets throughout the course of, as I said, the second half of 2020 into the first quarter of this year. So our focus on growth assets, our focus on positioning portfolios for the growth that we expect to continue to see through the remainder of 2021 has been clearly beneficial around the performance. And certainly if you're thinking about our balanced portfolio, it's had a significant rally over the last little while, delivering a little over 22% over the last 12-month period. So from our perspective, that's been really pleasing when we look at the changes that we've made in the portfolios having come through. If we just think about some of the market dynamics, though, over the first quarter, it has been very interesting. And I think the month of February was a real standout on that basis. We saw actually bond yields sell off quite aggressively in regards to the outlook for growth as well as the potential inflationary environment that may come through the second half of this year into 2022, just given the level of stimulus packages that we've seen not only domestically but throughout the world. And that actually resulted in fixed income markets delivering their worst ever performance since indices were created all the way back in the mid-80s. From our perspective, as you would have known through other conversations that we've had, we were wary and have been wary of rising bond yields and the implications that would have on the performance of fixed income as those yields moved higher. And so the positioning of our portfolio away from fixed income pretty much throughout the second half of last year, and in fact we increased that underweight position in the changes that we made in the first quarter, has really benefited the portfolios and the overall outcomes that they've been able to deliver. As we sit here today, certainly through months of March and into April, we did start to see that some level of stability come into fixed income markets. But notwithstanding that, our core view remains that as the economic outlook improves, and that's clearly going to be lumpy in the way that comes about given the challenge that we're seeing in countries such as India and the like. But as that economic outlook improves, we do expect that bond yields will continue to rise, and that will result in a more negative, flat to negative outcome for fixed income markets. And that actually sounds a little bit strange in context, but it's just the way that those markets and those investments have to be, as I said, valued on a day-to-day basis. So in that context, we certainly remain overweight growth assets, but we are trying to tilt our positioning in growth assets, not simply into equities, albeit we have added to our equity exposure. We've been looking at real assets, and we've been looking at growth alternatives as well as part of our overall portfolio configuration. We believe that provides a better balance in terms of ensuring that the portfolios can deliver what they're trying to do over the medium to long term. And that's always been our focus in the context of positioning the portfolios. But as I said, at this point in time, it's actually quite an interesting environment for financial markets, particularly the defensive parts of the markets, which we feel are arguably at greater risk of delivering underperformance or certainly a flat performance for investors throughout the course of this year and potentially into the early part of next year as well. So from an asset allocation point of view, it's a real focus from our perspective. Just the way that we, as I said, we manage the portfolios in order to, as I said, try and deliver a consistent level of performance through time. But the first quarter was, as I said, a very, very solid quarter for investment markets overall. We certainly started off the second quarter in equally strong fashion in many instances. As we head into the middle part of the year, though, I do expect that some of that performance will need to play catch up, and so we're not expecting as strong a second quarter as what we saw through the first quarter of this year. But as I said, overall, markets, in our view, continually look well primed, as I said, to deliver positive performance throughout the course of 2021. The major aspect on the front going forward is certainly the upcoming reporting season for Australian companies, and I think that'll give us a really good gauge as to the strength of those businesses over the last 12 months. Clearly, leading into the middle part of last year, it was a challenge, but we've really now had, arguably, quite a solid period for companies in order to, as I said, get back to some level of normality. So I think it'll be a really good gauge in the context of the strength of equity markets heading into the second half of this year, and equally we're seeing that on a global basis as well. As always, if you have any concerns or queries, I think the team would love to hear from you, and we'll look forward to catching up again soon. Thanks, and bye for now.